Good evening, ladies and gentlemen. This is Barry Norman on behalf of ETX Capital, and welcome to our Sunday class on The Trend is Your Friend. And that is one of the oldest adages in the financial markets, and it's something that everybody should live by. But those of you that are joining us for the first time tonight and don't know much about ETX, before we talk about the trend, let's talk about risk and regulation. ETX is a regulated provider, so therefore I'm required to give you a risk warning. Trading in the financial markets can result in the loss of the amount invested. Do not trade with funds that you cannot afford to lose, and seek advice if you do not understand the risk. ETX Capital and the presenter are not financial or investment advisors, and we do not recommend any securities or instruments of any kind. Any securities we talk about tonight are for educational purposes only. Now, ETX is a very fast-growing financial services company based in London. We are authorized and regulated by the FCA, that's the Financial Conduct Authority, and we're also a member firm of the London Stock Exchange. When you trade with ETX, if you're a beginner, you might want to start out on the ETX binary options platform. That allows you to simply decide whether an asset is going to go up or down, and your risk is only the dollar amount you type into the screen. If you want something a little bit more advanced and want to move over to spread betting or CFDs or Forex trading, you can use our ETX Trader Pro platform. That'll allow you to trade commodities, currencies, indices, and stocks using CFDs or the Forex market and an online trader and an online web account. You just simply log in and trade. We have our advanced charts. We have all the tools you need. And if you want to go up to the next step, which is for more experienced traders and professional traders, we offer the ETX MT4 platform that you download and you can use as you want. You can use it to add on expert advisors. You have the advanced charts, and you also can use it to automate your trading or some of your trading and do all the complicated order entry processes you would like to do on the MT4 platform. If you'd like to learn more about these or try them out, or get a demonstration on any of them, just contact customer support and they'll be glad to help you out and make sure you are trading the way you want to trade. Now tonight we're going to be talking about the trend. And the trend is your friend. And it is a motto that you should live by. You should always be trading in the direction of a trend. Now a trend, for the basis of understanding, is no different than what a trend is in fashion. If skirts are going up, the current trend is what? Up. If skirt lengths are coming down, the current trend is coming down. If we're looking at, smaller cars and the trend is towards smaller cars, that's where the trend is going. If we're looking at larger cars and that's where people are buying, then we have the trend towards larger cars. It's only a direction the marketplace is taking at the moment. Now, in order to see these trends and to capitalize them, we have to learn how to look and read a chart, because the only place you can see a trend is on a financial chart. Now, learning how to read a Forex chart is considered to be somewhat of a science. Some people think it's really scary. Believe me, it isn't. They look complicated at first glance. Forex charts can look drastically different depending on what options you want to use. Charts usually have settings for display styles for the price and the time frame that you want to view. Time frames can be viewed anywhere from 1 second to 10 years, depending on the charting system and the type of charts you want to look at. Now, the way I try to explain this to you is to make it something we can easily understand. And I'm getting pretty old, so when I try to explain this to you, some people don't even get the grasp of it, because I've been around and trading for over 40 years now. So that also means I was pre-GPS. And we used to use road maps. In fact, we used to use atlases. Now, I'm the kind of guy that would get a general direction of where I'm going, or call where I have a meeting and just say, tell me to take the highway, take the R5 north and get off at, exit 10, go a couple of kilometers and then turn to your left and look for the school. And when you see the school, we're across the street. And you know how much time I spent in filling stations asking for directions. Me and petrol stations were best of friends. I'd always have to leave a half hour earlier than expected or an hour earlier so I wouldn't be late for a meeting. Now, my business partner, he was an expert at maps. He carried an atlas in his glove box, and he would pop it out, and he would not only be able to tell you what highway to get on, what secondary street to get on, he'd tell you where the roundabout was, he'd tell you how many lanes were in, he'd tell you all the stuff along the way, and then if there was an accident or the traffic was backed up, he'd say pop off here, go down here, get on this highway, take this 2-lane road and get there, and we would never get lost. Now the difference was, if you think of maps like charts, was number one, the expertise that he had over me. I was only getting the bare basics, and he was able to look at a chart and see it as an expert. Now these roadmaps are basically your roadmap to success in trading the financial markets, because there are 3 basic kind of charts. There's a line chart, a bar chart, and then a Japanese candlestick chart. A line chart is just like the map I would be making. Hold on one second. People write in that somebody writes in they don't have sound. I can't tell them what to do. I cannot assist you. Just give me 1 second to type an answer here. Okay. Now, sorry about that, guys. So the first thing we have to do is learn to read a chart. And tonight's class is not about reading charts. Tonight's class is about drawing trend lines and understanding the trend. So we have an entire class, we just had it the other day, in charting basics. In that class, we'll learn about all the different type of charts and what the time frames are and what the view screens are and what they all try to tell you for the basics. But for me tonight, we're going to be looking at the bar chart. And the bar chart simply tells you the open, the high, the low, and the close in the particular time frame you are looking at. So if you're looking at a 15-minute chart, you have the open, the high, the low, and the close for every 15 minutes in each individual bar. And this helps us because it gives us a lot of information in a very easy to see, concise manner. So we have a doohickey we put to the left at the open, a doohickey to the right at the close. We put a dot at the highest point it made and a dot at the lowest point it made, and we connect these lines together. And that gives us how that asset moved in the time period we were looking at. So if we were using a 1-hour chart, we'd have the open for the 1 hour, the close for the 1 hour, the highest point for the 1 hour, and the lowest point for the 1 hour. If we were looking at a 1-day chart, we would have the high for the 1 day, the low for the 1 day, the open, and the close for the 1 day. And this becomes very important when we want to draw our trend lines, because we use these prices on the chart to find points in common. And now a trend line or trend lines are a useful tool for visually highlighting a trend and potentially for being part of a trading strategy. There are lots of mis and inaccurate information about trend lines though. Learning how to use a trend line effectively, if you're going to use them, is crucial so you don't fall into the very common traps. Now, the way I look at trend lines, to me a basic chart is either your blueprint or your roadmap. And then the more detail you're able to put on this blueprint and the roadmap, the more you'll be able to predict or understand how an asset is trading. Now, there are all types of customization you can do. There's all types of personalization you can do. But before you can do the personalization and the customization, you have to have the proper foundation. It's like a builder or an architect. He's designing a house for you. You can tell him you want 3 bedrooms upstairs and 2 bathrooms, and you want a marble bathroom with a circular bathtub in it. You can tell him all of that. And he's going to follow all the customization, personalization. You want blue bathrooms and red trim, and you want purple molding, and you want orange shingles. That's fine. But as an architect, he has to lay the proper building plans. He's got to show the right plumbing. He's got to decide where the electrical's going to come into the house and where the utility box should be. where you want your plugs in the house, where you want your light switches in the house, that's personalized. But he's got to have the right building blocks and the right foundation. And so first he starts out with his basic blueprint. That's what your chart is. Then he starts adding more and more lines to that blueprint. First he adds the ones he has to add. Okay. He knows what he has. He knows what the property line is. He knows where you have. So the builder who's going to build it from the architect's plans, he's got to lay that first block or that first stone or that first line he's going to lay and make sure it's plumb so your house doesn't end up on an angle or tipping over. Okay. Well, all of these are the basic building blocks. After that, again, it's all personalization and customization. So a chart is either your roadmap or your blueprint. And the first line you're putting on that chart or your blueprint is the trend line. Regardless of what trading system you want to do, no matter how you want to trade, trend lines are crucially important. Now, why? They don't really predict where the market's going. They don't make you any money. They don't tell you what to trade. And they follow very specific rules. Because what a trend line does, it goes on a chart at specific points following specific rules. So that means that you, as well as a million other traders around the world, are drawing the same trend line on your chart. Well, you're saying, well, that's kind of crazy. How am I going to make money if that guy knows what I'm doing, and that guy knows what I'm doing, that guy knows what I'm doing? Well, before we think about making money, wouldn't you think, or wouldn't it be advantageous to you to know or be able to predict at what price level there should be some market reaction? Now, we're not saying go up or go down. We're just saying what price could be strategically important to the markets. Okay. Well, if you draw your trend line on, you're looking at the right price that everybody else is looking at because they have the same trend line. So they're looking for price to touch that trend line, bounce off that trend line, or break through that trend line at the same price. So all of you are looking, say, the euro at 115.42. Well, doesn't it help you to know that that price is strategically important so that you can sit back and know at 115.42, I'm going to be very cued into what the market does, and I'm going to base my decision on how the market reacts at that price. So trend lines are a technical analysis tool used to define and project price trends in major markets such as stocks, Forex, and futures. Trend lines have the potential to alert us to a pullback or move against the trend is over or the trend is resuming, or when a trend is accelerating or reversing. Price is the ultimate indicator, though. Therefore, price action must always be considered when using trend lines. Now, trend lines are drawn on charts to help predict the general direction of price. They also help to see reversals. Trend lines also help determine good entry and exit points. Wow, they should be called magic lines, right? Well, not really. They are quite good at giving us information and helping us to form analysis, but they're not going to help you make much profit. However, they make a great addition to your trading arsenal, as well as keeping you cued in and on the right level, okay, and the right keel. Okay. If you know that a market is rising and you can use a set of rules to see that that market is rising, you have some critically important information. If you see that the market is rising but coming off of that rise, maybe it's about to reverse itself, or maybe it's just taking a breather for a minute. That's a critically important piece of information. But the main problem with trend lines is placing them on your chart. It can be a little intimidating to start with, but it's quite easy once you get the hang of it. Because lots of people think that you can draw a trend line anywhere connecting two prices, and that becomes a good trend line. But that's not the case. If you follow the strictest set of rules, you will have the best trend line out there. And again, you will have the trend line that tells you where price is going and what prices are critical to the market, just like the guy in Romania and the guy in Bulgaria and the guy in Paris and the guy in London, and you're all looking at the same thing. The purpose of drawing trend lines is to identify where possible reversals will take place. They can also signal a change in the trend may occur. Now, in an uptrend, we draw the line along the lowest points of the trend line without letting the line cross through prices. You need at least 2 touches to draw a trend line. Well, that sounds pretty easy, doesn't it? Well, it's not. So when we have an uptrend, that means prices are moving up. Because remember, we can have 3 trends. We can have an uptrend, a downtrend, and a sideways trend. When prices are ranging or congested, they move in a sideways trend, and that is considered a trend also. But when prices are moving upward, like you see in this chart on the screen, we would draw the trend line underneath the prices. Because what this line is doing is supporting the prices above. And what we want to see is the development of a trend. Okay, not just the line. Because we have weak trends, we have strong trends, we have good trends, we have tradable trends. Because the market doesn't move in a straight direction. A market doesn't just go up. A market moves in a series of peaks and valleys, or pushes and pulls, or thrusts and eases. So what we want to see in a well-developed trend is push and ease, push and ease, push and ease, push and ease. Okay. Now, the important thing is that when price eases, it never falls below the trend line, and that each time it eases, it doesn't come below the previous low. If it did, it would have broken the trend line anyway. But this tells us we have a very well-developed trend, and prices are most likely to continue going up following that trend line. Now, there's other pieces of information we need to add to it, but this is the first piece of information we're getting. Now, to draw a bullish trend or an upward trend, what we want to look for are what's called the swing low point. The swing low point is the point in which the lowest price that asset touched after it came off of a previous trend. So in other words, we'd be looking for what's called the swing low in an uptrend. Because if price is moving in an uptrend, at some point, it was moving in a downtrend before it moved upward. When it reversed and started moving up, that lowest point is called the swing low. Now, you could be looking at a 15-minute chart and looking at prices over the last 2 hours, or you can be looking at a 1-hour chart and looking at prices over the last couple hours. You'd be looking at a 1-day chart. We're still looking for the same thing on that particular chart, not for that particular asset. Each chart and each time frame we're looking, because you can have short-term trends, medium-term trends, long-term trends. So we can see that the euro, if we go look at the euro in a live chart, we will in a minute, is in the middle of a long-term downtrend, but we have an intermediary strong uptrend. Now, once we've found the swing low, we want to draw a line out from that price that has not been broken by any other lower price, and we want to connect at least one other swing low. It must have one other point in common to draw this line. Now, this line that we're looking at on this chart, even though it's a very pretty line, hasn't been validated yet because it needs a third touch to be validated. So what we're looking at is we're looking at a potential trend line, but that hasn't been validated. It must have a third touch of the trend line to become a valid trend line. And this is what becomes crucially important, because lots of beginning traders say, oh, I can always connect 2 points together. Yeah, you can. It's connecting 2 points together that have any validity. And therefore, you want these stringent rules because you want to be drawing that same trend line everybody else is drawing. Now, in a downtrend or a bearish trend, it is just the opposite. Remember, when you're trading, you have up markets and down markets. In most cases, the rules just flip. So here we're looking for what's called the swing high because the market is falling. So when the market came off of an uptrend, it reversed and formed a swing, a swing high, and then started coming down. Here again, we've connected the two swing highs and brought that line forward. But at this point, we don't have any third touch, so we don't actually have a valid trend line. We have a trend line, but it's not been validated yet. Now, anytime a trend line is broken by a price moving through it, that trend is also considered over. Now, because we want to draw accurate trend lines, we need to understand markets and prices on charts. Now, when we say swing highs and swing lows, and when we say no broken or the lowest point or the highest point, we have to use a wee bit of common sense, because we're looking for this, what we call the strategic or the important swing high or swing low. Or, for instance, if you have this beautiful trend line on your chart and for 1 second price goes through it, because for 1 second somebody sold 1,000 shares of Apple just because they needed to raise money to pay for their house, okay, and it pushed the share of Apple down for 1 second, that doesn't necessarily break the trend line, okay, because it was an aberration. It wasn't a strategic price move. Market recovered a second thereafter and went back to that trend line. Or when you're looking at a price, say the euro was going up steadily and Mario Draghi came out and said something negative about the euro, and it said the euro being very volatile, sent it way down, but a minute later it recovered. It still went on a downtrend, but that 1 second of volatility, you would not use that bottom price as your swing low or swing high, because it was not a strategic price. It was something that happened for a second. It was a blip in the market. So remember, the trend is your friend, but like all friendships, it's a complicated one. Unless you understand the nature of a trend, your friendship is destined to fail. As any trader quickly realized, there is a great deal more to trading successfully than merely identifying a securities trend and buying pullbacks in an uptrend and shorting bounces in a downtrend. So let's go over to some live charts I have popped up here. Let me bring them up on your screen. And we're going to be looking at what we just talked about. So here we have the euro US dollar. We're looking at a 1 hour chart, but I'm going to take it back to a 1 day chart. Because now, if we're looking at a 1 day chart, which is taking us all the way back here until December of 2016, we would see that the euro is trading in what? A very defined uptrend. So if you were to say to me, Barry, the euro is trading in an uptrend, I would say to you, hold on, I'm just trying to get something off my chart. Okay. I would say to you, okay, are you talking about a short-term uptrend, a medium-term uptrend, a long-term uptrend? Because the euro is also trading in a shorter-term uptrend, because we were going to go look at the euro in 15 minutes, a 15-minute chart. We can see since the 14th, the euro has been steadily trading upward. But then if we were to go back and look at it on a 1 week chart, we see something a little bit different. The euro isn't trading in an uptrend. We see a short-term uptrend, but the euro is trading in a downtrend. So by knowing that the euro is way below its average trading range and is moving in a longer-term downtrend, you start to understand something about the market and can start talking more intelligently about an asset. Because we go back and look at it in a longer term, okay, and this is taking us back until 2000, the euro is almost in a sideways action. Because we can see right here, look at all of this, and look how strategically important this price level, where the euro is, that 120 level, has been to this euro over the last 5 years. We can see lots of importance here, lots of importance here. Look at that there. Look at this here. Look at this here. So we start to see that 120, or actually 119.50, is a crucial point to the euro. We also can say the euro now in a longer term has been trading in a longer term uptrend. It reached a maximum high right about here. Hold on, let me turn my marker off here. At 159.50. Okay, and that was in 2008. That was right at the edge of the financial crisis. It's probably right when Ben Bernanke was starting to do QA in the U.S. and the dollar plummeted, which allowed the euro to go skyrocketing. But we can see since the financial crisis, the euro's really been in a downtrend. And why? Because the U.S. central bank has been more reactionary and is now moving into more monetary policy easing, while the European Central Bank has been staying status quo. We're expecting Mario Draghi this month to start mentioning more about normalizing policy and the euro to keep gaining on the dollar. But that's besides the point. So these are the differences in trends. So we have long-term trends, short-term trends, medium-term trends. We also have other types of trends. Like here, we have a trend channel. We've drawn an upper. This is gold, and now gold is currently trading. We've drawn a uptrend underneath the price, and then we've done is we built a channel by also building an uptrend over top of it, and we do this by using a tool that draws a parallel channel for us, and it keeps the angle the same when we draw the trend line, and then allows us to fan it out at the same angle. And what we're doing is we're encompassing the lows to form the uptrend, and then we're forming a channel around it. And look how beautifully price has been trading in this channel all along. Now prices just touched the bottom of this channel here, so we're expecting price to move back up and move into this channel. Okay. And every time it has touched this support line, we would have been trading this long to go back in to bounce back and recover into that trend. We can also see very beautifully push and ease, push and ease, push and ease, push and ease, push. Let me just get this off of here. Push and ease. So we have a very developed uptrend. So we're starting to make some sense of the markets using trend lines. Okay. And this is a very simple tool. Okay. We're not making trading decisions, but we're using very, very simple tools. Now, one of the most important ways of using or trading strategies uses something called divergence. Divergence is when the trend line is moving or price trends are moving one direction and the indicators you're using are moving in the opposite direction from the trend line. Now, we're not going to get into that. It gets in more advanced technical analysis, but there are all different ways that you can use trend lines. So let's go back to my PowerPoint and let's talk about this a wee bit more. Okay, so let's begin with the basics. We've talked about these, but I'll keep reading. An uptrend is a series of higher highs and higher lows displayed on a price chart. A downtrend consists of lower lows and lower highs. A sideways trend is a trading range in which the price of a security swings back and forth within a sideways trading channel. Now, there are two major obstacles that you will run into when attempting to apply traditional wisdom. First, not all trends are regular. In other words, while one type of support level may hold well in one uptrend, okay, such as popular 20-period moving averages, in another trend, it might hold to a 10-period moving average on a one-time pullback. then a 20 period for a second time. Each trend is different. So as you can see when we look at the trend channel, it was a nice, well-developed trend, but you can have some that aren't so well-developed. You can have some, so what we do is we use something called a moving average, which is part of your strategy, because the moving average smooths out the price movements, and we use that with the trend line, because again, we want to be talking about strategic prices, not irrelevant little price blips. So you also want to keep in mind that no trend lasts forever. At some point, an uptrend will become exhausted and will break through support instead of pulling back into bouncing. And then we'll continue higher once again. You have to look at a market and say, okay, is the market getting ready to reverse, or is it a retracement? Now, there's other tools to help you, but some points, you have to remember, we have buyers buy. At some point, they take a breath. They may be waiting for a piece of news. They might have bought up a ton of stuff. Now, when we incorporate trend lines with support and resistance lines, as well as volume, we can start interpreting this. But right now, with just a trend line, we can't just make interpretations. Now, a trend line gives us a form of support. It's supporting the price movement that's moving up along that trend line. In other words, every time price eases down, we would expect it to hold at that trend line price and bounce off of it. If it breaks through that, then that support trend line becomes a resistance trend line, and we would expect price to continue to fall, but as it recovers, when it comes back up to where that pre-existing trend line was, to bounce back off of it. Now, without a solid understanding of how trends exhaust themselves and the tools for recognizing different types of exhaustion and how they affect the correction of a trend, you can easily find yourself on the wrong side of a market move. Most traders who pick up a book on technical analysis run into the concept of trend formation or trend development, whereby the trend consists of 3 waves of upside that are often punctuated by 2 smaller corrective waves. Templates for trend development are typically similar to the one you see over here. But again, it's about push and ease, push and ease, push and ease, push, ease, push, ease, push, ease, push. Now there is a strategy based on 3 waves up and then 2 waves down. It's a common development, but that comes off into strategy. There's also things like Elliott wave patterns, or cyclical waves, because markets do move in waves. They move in trends. Now, the first thing though is you have to always draw your trend line correctly. This trend line becomes just a tool in your toolbox. It starts to help you make some heads or tails of the market. Now, first of all, we should define what we expect out of a trend line. There are legitimate trend lines connecting lows of a move to highs of another move, drawn on a best fit effort through the center of a price action, or drawn through any number of other chart points. I have not found most of these to be useful in my own trading because I expect something very consistent from a trend line. The main reason I will use a trend line is to delineate the conditions that define the current trend of the market. If the trend line correctly defends those conditions, then penetrations of those trend lines are significant. Now first, the trend line defines the limits of the swing that compose the trend. So it's important to be sure there actually are swings before you draw a trend line. For instance, if you see many consecutive bars where you can draw a line across the lows of the bars, this tends to be a common in parabolic moves near the ends of trends. A trend line drawn across those lows will probably not be very meaningful. So remember, once a trend line is placed and it has a third bounce, it becomes active. Now the price should find support and resistance at that trend line. Now, sometimes trend lines can go on very, very long. The more times price touches that trend line and bounces off of it, the more significant that trend line is, and the more it tells you about that price movement. It should always have trouble breaking this line. If price does break the line, it usually means the trend is over. So placing lines is pretty easy. All you need is to identify two swing lows or high points. Draw a line between them. There you have it. Now your chart has trend lines. But wait 1 minute. Even though you can place a trend line based on two swing highs and two swing lows, the trend line remains unconfirmed until it has a hit a third time. So you need to have predefined trends with rules. So in other words, this is the chart we were looking at that we started this whole class with. And here we drew our swing lows, extended our line out here, and we had the third hit. This then became a validated trend line, and price moved up off of that trend line. So that told us our trend line was going to push and ease, push and ease, push and ease. Now, as we move forward, push and ease, we had our validated trend line. Price moved up and then fell back down and came to that trend and broke that trend line. In other words, when it did that, and it did it so violently and continued downward, that trend had ended. So we could have made some important decisions. If we were in the market at that point, we definitely would have wanted to be getting out of that market. If we were looking to enter that market on that bounce, we wouldn't have been entering, but we might then want to trade that price to go down. Trend lines can be placed in any time frame, but they're more effective on longer time frames. Also, the longer a trend line is active, the stronger it gets. So, unfortunately, we have a lot of people who would like to draw a pretty trend line and an easy trend line. So what they would do is, this is the same price movement we saw before. They would take this swing high, swing low, and they would extend it out to this swing low and project it forward and ignore this. That cannot be ignored. That isn't a strategic swing low. This is a definite breaking. So this trend line would have been invalidated here and never extended out there. And if you're sitting there looking for a price action, at that point, you'd never get it because you'd be at the wrong price level. This is how you would have drawn it, connecting that swing low, and projecting it out here. And then if price came back towards that, you would have gotten a very important price action and made some important decisions. So remember, you connect swing lows to swing lows or swing highs to swing highs. The more connecting points and the more times it has stayed active as a trend line and the more bounces it has, the more important it is. And each time that you see price bounce off the same line, the more likely it is that others are watching it too and are playing the same game you are. This could help you get several good entries in a row, but remember, trend lines won't last forever. So you want to make sure you set proper stop losses and get out quickly if the support and resistance trend line eventually fail. The other thing is, we started out this class, what's it called? The trend is your friend. What does that mean? It means you should only be trading with the trend. It means you will statistically make more profit and more pips in an uptrend trading in buy positions. In other words, when price bounced off the trend line, you would then buy into that movement, trying to predict the tops and sell, or trying to predict when the trend line you might be correct, but the movement you'll get, the pips you'll make, will be insignificant to the amount of pips you would have made if you traded with the trend line. Statistically, if you trade with the trend line, you will be right more often than wrong and make more pips. And ultimately, it comes down to how many pips you make. So the trend is your friend. This steadfast rule also applies to trading trend lines. For experienced traders, this basically means we should only look to buy at bullish support lines and sell at bearish resistance lines. For traders not in a trading bargain, let's follow the images here. You would only buy into up moving trends. So once you had a validated trend line and price bounced off that trend line, you would be buying up into that trend and continue with that trend. In a downtrending market, you would do exactly the opposite. So trading in the direction of trend will let you exploit potential trend line bounces as efficiently as possible. And while they won't always give us winning trades, the trades that are winners should give us more pips than we had been attempting to place trades against the trend. So coming full circle, trend lines are a very simple tool to use. You are connecting dots on a chart, but hopefully the 3 tips that I've given you will take you to the next level. Make sure that the lines you draw are connecting 2 or more highs or 2 or more lows, but have not been broken by price between those points. Remember to look for a third bounce to validate a trend line. Also make sure you're taking advantage of trading with the trend by looking for buys in bullish markets and sells in bearish markets. So whether you use trend lines or indicators, price action is what ultimately determines how much money we make. Learning about price action, how trends move, is never a bad idea. Once we understand the basic concepts of how price moves, then trend lines become a more effective tool. Now, today's class is simply a class in building your roadmap to success. If you weren't with us for our basic charts and graphs, we give that class over and over. Then we learn to put trend lines on the chart. The next step from here, we're going to learn to use support and resistance, and the concept of support and resistance, and volume. And to be honest with you, lots of trading systems or whole strategy that people use are based on only these 3 elements. Lots of automated trading systems based on volume, support and resistance levels, and trend action. And you could take those 3, I call them your building blocks of success. I don't think no matter how you trade, what you trade, why you trade, these 3 things should be incorporated. And if you're trading from fundamental news, you're trading from press release, you're trading from earnings reports, these 3 pieces of information should be on your chart. And this is what you should be looking at, even if you're not using to make a decision. It could warn you you're making a mistake. It could help you stay in the markets at the right point, stop you from panicking if there's a drawback. And these are your building blocks. After you get these building blocks, then you can add all kinds of strategies. Okay, I don't consider these strategies. I consider them your building blocks, understanding the asset you're looking at. And on that note, I'm going to say goodbye to everybody. Thank you very much for joining us. I'll see you in class on Wednesday. And we do have this month a class on trading the trends and learning how to actually just trade from the trend lines. And join us for that class, and we'll see you again. We have a lot of classes coming up this month and a lot of new classes coming in October, November, December. So thank you very much, and have a great trading week. And thank you for being part of the ETX family. Good night now, and enjoy the rest of your weekend.